All right, it's my pleasure to have you here. So Erica, tell me a little bit about yourself.
Well, as you said, I'm born and raised in Ottawa, and I've been here my whole life, and I've worked in the service industry for probably about 10 to 12 years. From there, I moved on. I went to another business that kind of reached my peak. I couldn't get much higher, got to a management position pretty quickly, and after that, felt that I wanted more challenges. Left that position, and mortgage brokering just fell right into my lap. I wasn't expecting to become a mortgage agent, and I can't imagine my life without it now. It's been really great. I've owned a couple properties. I'm also a landlord, and so I really am passionate about real estate at the same time.
Good. So you are able to advise people from a mortgage standpoint, as well as you can speak from experience as being a homeowner.
That's what I think I have the most benefits towards my clients, is because I've done so much in the real estate industry myself that I didn't read everything from a book. In fact, when I did read the book for my course to become a mortgage agent, I thought, God, why wasn't I told this when I was so young buying my first house? I thought everyone should read this book before they actually buy a house, because you just become so much more well-informed. So yeah, my experience is really what carries me through in this business.
Good. And why would someone come to see a mortgage broker instead of going directly to a bank?
Well, a mortgage broker really has an opportunity to give more options. Typically, we get about 2% less right off the bat from the bank's posted rates. We also have, coming to see me is like going to see about 30 different lenders. So you only have to do the work with me once, as opposed to going on your lunch break or after work on your spare time to go to, I think I can think of maybe 9 or 10 banks in the city off the top of my head. So instead of going bank to bank to bank, getting your credit pulled every single time, filling out the same information every single time. With me, you do it once, and then I go and do the work for you. I find the best rate. I find the best mortgage product for you and your needs.
So when you mention the credits being pulled each time, does that affect your credit rating itself?
Yeah, it is pretty marginal. It doesn't, knock 10 points off of you. But if you go see, let's say, those 9 banks within Ottawa, then all of a sudden those marginal hits become a little bit greater. So having a mortgage broker pull it once, and I share the information with all the lenders that I have access to, it just saves you time and money and probably headaches
by doing that. Speaking about credit once more, what would you say are the key things to ensure that you have a good credit?
Well, I usually say that credit is a very complicated matter to many people, and I try to break it down into 3 categories. I say that don't have too much credit. Keep your credit cards minimal. Don't overextend yourself. So if you have a few credit cards, make sure that you're not going up to the maximum balance all the time. And most importantly, always, always, always pay down your minimum payment, at the very least your minimum payment, if not the whole balance. But that's my the 3 key elements to credit, I think.
Yeah. And when a client comes to you, what are some of the key documents that they should take to see?
Well, I would go through, first of all, the application, and then through that, some of the most important information to have when you come see me would be anything to prove your income, anything to prove employment, so an employer letter. Your income can be proven through a T4 or through a pay stub or through last year's notice assessments. And anything to prove where your down payment's coming from. So if it's a gift from a family member, then let me know that that's the source of the down payment. If it's in your bank accounts, typically a lender will always want to see 3 months bank statements as well. So those are some of the right off the top you'd want to bring with you.
Okay. What are the main tips for pre-qualifying?
Typically when I want to pre-qualify someone, I just take a look at their income and their liabilities, so any debts that they have. And a good formula to think about is 42% of your income, your monthly income, has to cover all of your debts, including the mortgage, principal, interest, your property taxes, and any other revolving debts that you have. So that's kind of a good formula to go by.
So if you do your calculations and you find that your income is, you're using up, say, 60 or 70% of your income to be able to survive, then what would be your recommendation to an individual?
I would say the first thing is that you're not ready to buy a house if you're over the 60% mark. That's pretty steep. The best thing to do would just look at your finances. Speak to a financial advisor. I can go through your credit with you. I can go through your income. Think of how you can reduce your debt load. What can you pay off the soonest? What can you eliminate from your debts? Also, maybe look at a less expensive house. You know, some people want to get into the housing market, and right off the bat, they want to get that $450,000, $500,000 home with granite this and, you know, countertops that. But really, maybe it'd be beneficial for you to get a townhouse or a condo just to get into the market. Wait a few years, then you have the equity built, and then you can move on to a nicer home.
Okay, good advice. How do you help people to determine what house itself are they ready for in terms of the value of the house? How do you determine that?
Well, I take a look. When I talk to my clients, I really, more than talk, I listen the most. I try to understand what's important to them. And, you know, I listen mostly to the budget. What is their monthly budget? That's typically my first question that I ask. You know, what are you looking for to pay on a monthly basis, and what's important, what's comfortable for you? And through that, then I'll base the type of housing that they can find.
Right. And what about the size of the families? And is that a typical, something that is very important for when you're looking at how the house that should be purchased?
Well, I'm looking more at the mortgage amount. So the house is more the real estate agent, which is their area of expertise. So I'm just making sure that the mortgage amount is affordable for the family and for the people, the individuals.
Let's talk rates. I've been seeing several different advertisements, and clients have come to me and they've told me about the different rates that they're getting that are available. How do you, what are the latest rates for, say, 2013?
The rates are incredibly low. It's historically low. I can't stress that enough. What I would like to add, the current rates right now are anywhere from about 2.79 to 2.99 up to 3.14. It really depends. Are you business for self? You know, do you have reliable source of income? There's a lot of factors. And what I actually like to share with my clients mostly is that a mortgage is not just about a rate. It's about the product. What's important to you? Are you wanting to move in 3 years? Are you wanting to pay down your mortgage sooner? You know, what is important, which I listen to through the meeting of my clients, and that's when I determine what the best product is. Saving, you know, a 0.10% on an interest rate monthly accounts for probably, on average, about 40 cents a payment. So don't go after the lowest 2.89, 2.79, 2.99. Rate is important, but overall you want to make sure that the product is right for you, that it can be transferred, that it's portable, all those important key factors for you.
Okay. In terms of some of the terms that people should be looking out for in these agreements, because I know there are several people, before they actually, the prudent person would bring their mortgage agreement to me before they actually sign it. What are some of the key issues that they should be looking out for in these types of agreements?
You want to make sure that you're looking at the portability. Can you take this mortgage to another home if you decide to move? Can it be transferred to a new person that's moving into your home? That could be a really great selling feature if you have a low rate of today and they're moving it, someone else is moving in. Can it be transferred to the new homeowner? Penalty is a really big factor that you really want to make sure that you're paying attention to, because penalties can really hurt you so much when it comes to selling your house. If you think you're going to be somewhere for 5 years, you leave after 3, that penalty can hurt you a lot.
What's a typical prepayment penalty like?
It depends really on the type of mortgage. Penalties are broken down into 2 categories. One is an IRD, which is interest rate differential. That's a percentage of the interest that the lender is going to lose by you breaking the mortgage. The other one is 3 months interest penalty. The IRD, interest rate differential, can be, I've seen upwards of $14,000. It's pretty high, and as low as 3 months interest. So on an average home right now, I think the last couple mortgages I did was, you know, maybe $800 to $1,000 in interest a month. So you're looking at about $3,000 to break that penalty.
Okay. There are some people who have discussed first and second mortgages. I've even seen people with bridge loans. So that's like 3 different mortgages that are when they're purchasing their home. What would you say about that? What would you recommend to people?
It really depends on where you are and what your need is for the second mortgage or a bridge loan. Bridge loans can be sometimes when you're moving from one home into another home and there's a gap in between, so you can bridge it to the next property. A second mortgage is sometimes someone who needs access to cash right away. So it really kind of depends on what you need the loan for. That would better answer that question.
And you should not
need a little bit more information.
You should not be taking a loan as your down payment.
No, you can still do that if but it has to still work within those ratios. So that 42%, of your gross income, you want to make sure that if you do take a debt for your down payment, that it's still within your affordability.
Okay. What are some of your tips to clearing your mortgages faster? What are some of these tips that you would give to the clients?
Oh, paying down your mortgage fast.
Yes.
Paying it down quickly is really great. You want to, some really easy tips is paying accelerated biweekly. That's paying every 2 weeks, so you end up paying 26 payments within a year instead of 12 or 24, whether it's monthly or bi-monthly. That actually reduces your amortization, sometimes about 3 to 5 years, a couple extra years within the term that you're working with. Another great way is something as simple as tying an extra $25 to your mortgage payment. I say this in my YouTube channel in one of my prepayment videos. Basically, if you do $25 per payment accelerated bi-weekly, that you want to, it's about $700 extra a year. So over 5 years, that could be about $3,500. So you're paying it down really.
Share with them about your upcoming event. Tell us some more about that.
This is a free information session that I've been putting on with another.
And we do have a slide for that focuses on this event that is coming up on the 17th of April. Tell us more about this.
This is the Live and Learn free information session. We're talking about basically to parents and to students who are going to be going to university in the next couple of years. It's a way to live rent-free, possibly pay off your student loan at the end of the term. It's student housing, but not on-site. It's off-site student housing as an option.
Okay, and this will be on April 7th. So and where will this be?
It's going to be April 17th at 6:45 p.m. at 880 Lady Ellen Place. It's in the Carling-Kirkwood area. And seating is limited, so feel free to contact me for registration.